Hello everybody and welcome back to the channel. Today we're going to be taking a look at Verizon stock and see if it would be a good investment to add to your portfolio. So if you don't know, Verizon is pretty much an American telecommunications company headquartered in New York. It is the world's second largest telecommunications company by revenue, and its mobile network is the largest wireless carrier in the United States with about 146 million subscribers. Some other companies you might have heard of inside this sector would be someone like AT&T, T-Mobile, and so forth. Now, currently, as you can see, the stock is down 0.36% in the past year. And if we take a look at the 5-year chart, it looks like it took a hit as well. So this is one of the main reasons why I'm looking to invest, to see if there's a potential here to buy this stock and get a return in the future. And not only that, if we take a look at the dividend yield, boy, oh boy, it's at 6.78%. Now, this isn't the intrinsic value of Verizon, but as you can see, analysts are predicting this stock to go from 39, where it's currently at, to around 47 to $47.50, which gives you a little bit of breathing room of about $7 to $8 while getting paid that 6% dividend. And if we take a look at this chart, we can see the comparison between institutional buying and selling by quarter for Verizon, and you can see quarter over quarter it's been increasing and getting bought more. So if big institutions are buying a company like this, what does it mean for little fish like you and I think this might be a good thing. Obviously they risk a lot smaller percentage in their portfolios than we do, but I mean, as you guys just saw in the previous slide, this is the second largest company in the sector. So if we take a look at the overall ratings for the Wall Street analysts, this stock is currently at a buy of 3.72 out of 5. There's 6 strong buys, 6 buys, and only 13 holds, with 0 sells and 0 strong sells. Now, taking a look at their earnings, we can see that pretty much every single time they've beat their earnings, and this is what they're expected to do in the future. They're expected to fall short in Q1 of 2025, but they will pick back up in Q2, 3, and 4. Their annual revenue is expected to be 136 billion in December of 2025, and that is going to increase to 139 billion in December of 2026. I like this to always be increasing in a company, the EPS and the annual revenue, just because I like to invest in the company, as I just said, because of its dividends. And when the company is making more and more money year over year, they're more likely to keep increasing their dividend. Now, I know it might not seem a lot to only be an extra $3 billion in profit, but I mean, guys, this is a huge company, 136 billion. Before we hop into intrinsic value, let's go ahead and take a look at the net income and total revenue for this company. As you can see, it was increasing in 2020, 2021, 2022, and then it fell short in 23, came back up in 24, and now year to date is currently at 134 billion. Same thing for the net income. We can see they had a good year, then it increased. It started decreasing ever since, but it's currently picking back up. So in my opinion, if now is the time to add a stock to my portfolio, is now, when the stock is not at all-time highs, when it's down in the year. They're picking back up on the revenue and their income, they're increasing their dividends. It just shows healthy growth for me. So this is why I'm looking into the stock. So now let's take a look at its intrinsic value. Now, to look at the stock's intrinsic value, we're going to need 2 things. One, we're going to need the ticker for the company, which is going to be VZ. And this formula, guys, keep a lookout, because in a video or 2 I'm going to be adding it to the description so that you guys can see this as well. And another thing is, we're going to have to look for the growth rate projection of this company. And to do that, you simply go to Google and you put Verizon future growth forecast. Now, most of the times I like to use simply Wall Street, because as soon as you click in the link, it'll give you the earnings growth rate, which is 5.7. You go here, you input 5.7, and as you can see, in both Graham's original and updated formula, the stock is a buy, and also in the analyst revised formula, the stock is a buy as well. Now, however, I don't like to buy stocks just on their intrinsic value. I have to have some sort of margin of safety, which is this down here. And what that means is a discounted percentage of the intrinsic value to then be able to be safe in this company if it does decide to drop back down. So for example, this company is currently at $39 and the intrinsic values could be between $46 and $82. Now, I could buy it here. Yes. Would it be a good investment? Let's take a look. If we have a margin of safety of 35%, that means we could still buy this company at $47. So we're going to be getting this company at a margin of safety of about 60%, since it's currently at $39. Now, as you can see, the upside return you can make on this, depending on which formula you're using, you can make around 17%, 83, or 106%. What do you guys think of this company? You think the future looks good? Do you think the competitors are just gonna take away all the moat they have? And let me know if you think this is a good investment for your portfolio. I personally started a position on this company. However, I'm not a financial advisor, so please do your own due diligence and not make a decision just because of this video. But I do think this company has some growth to go, and now that they increase their dividends, I like it even more. Thank you guys so much for watching. If you enjoyed the video, please consider leaving a like and subscribing, and as always, I'll see you in the next video.